All right, I'm going to try to do this as quickly as possible, but I see it being quite long-winded, to say the least. Um, so first, these are the things that I want to go through, and then we're going to look at some price action. I am in market replay. This is not live, clearly. We are back on Monday. So first thing I want to look at, though, is just my indicators that I have on the chart. These just help me plot things that I don't want to have to plot manually. That's all they really help me with. So we can see first one I have here. This plots, and we can talk a bit about session liquidity, I guess, here too. This plots sessions for me, or you could call them maybe kill zones. We'll highlight the boxes just to show it for the sake. I use this on most of my other charts, but this is a new layout I've been using recently because of something else I'm using down here that there's too much clutter if I use both. But you can use it. You can see, I mean, you can't really see much here, but like you can see in something like this right here how we took out this AM high and then we completely reversed. You can see something like that is quite a repeating thing. Or you can just more look at it as the draw for price. So we can see here, we make an equal low with the AM, and then we came in and took it out. So it's not that we took it out in reverse, but you can see when you're getting in shorts up here, what are we targeting? We're targeting the lunch low and we're targeting the morning low. That's what you're targeting. So it's nice to know for liquidity. So we can take, that's what session liquidity is. Session liquidity are these highs and lows of the last session. And I'm gonna go to the next one right now too. The PXH and PXL is previous X high, previous X low. That could be day, that could be week, could be month, that could be last 3 days. So we can take I don't want to flip to the daily chart yet, but we'll throw this indicator on now. We can see this is plotting the previous day high and low for me. So you can see something like this AM session here. This was a great example. Now we have the Asia low, Asia high, and previous day high right here coming into market open. You can see what we did market open. We came up, we took this London high at 2460, and we retrace a bit into this gap right here, which we'll talk about shortly. And honestly, if you wanted to look at a trade here, your trade would probably be something like this, and you would be targeting. I mean, you would target, probably take off at the first one, or this previous day high, or look for like a little run above it. But you can see how here we hit this level and then immediately reverse. Now we don't reverse far, we reverse to. All right, I guess we'll get through all the vocab now. So what we reverse to here until we come back up in this, this is I want to use this. This is a bullish order block. Now, a bullish order block is a down close candle during a move up. And you can also have the inverse. You can have a bearish order block, which would be a up close candle, so a green candle on the way down. And if you just want to see the algorithmic side of this, you telling me that that's not precise enough, that that's just random? Just highlighted that now, completely just random, and you can see that. So that's all that really needs to be said about that. But you can see here we came down to an order block. Now if I'm going to look at down here, in the 2022 model, which is what this is kind of listed up, 2022 mentorship, ICT will always say when you're looking for the model, you need to have always allow for the first fair value gap to be entered into. So this is a fair value gap when the high of the first candle is lower than the low of the third candle. The second candle creates a fair value gap. Now we'll use a box for consistency's sake, and we're going to make it regular color. So we can see here, this is the first one. Now, if you were on a 2-minute chart, this would be one fair value gap, as we can see here. Well, the fair value gap kind of goes away when you go on a 2-minute chart. But when we drop back down to a 1, we can see that we have this fair value gap. Now, talking about fair value gaps, let's finish with PD arrays. So PD arrays are the category that all of these things that ICT teaches falls into. So it's a period array, PD array, short for short. Order blocks are that. Fair value gaps are that. Breaker blocks are that. So now what's a breaker block? So now when we look at this order block entry, you can tell here there's a lot of up close candles in this move down that we don't trade back into. Or you wait till the whole way down here and you have this up close candle. I mean, we go up from here. It's not a good example. Let's say this candle. We have this down close candle. Now I will say when you have 2 down close candles, you need to look at them as one order block. So you look at that as one whole order block. Right there, those 2 down close candles together. You go here to here. That would be your order block. But you can see here that this is quite a large, relatively. This would be 491 to 473. Looking at the right side of the axis there, it's about 18-point order block. It's a bit large to be taking an entry on the top, and you have to have your stop below the bottom. So especially on like this, if you were taking a trade here, something like this, and again here, remember we're looking for the session liquidity. So I mean, you almost look down here, and again, it's to some degree we have all this to the right, so we can tell that we got down and made this an equal low, and then we don't know what happened after, but I'm pretty confident that later in the week we end up and we come hit this. But saying that, you don't take a trade up here with a 9-point stop loss and you don't hold for this. You don't need a 17R trade. You look here at this 932. We open up, we swung low into this fair value gap, and you target right here. This so this is a call. This could be called a ITL, intermediate term low. This would be most commonly referred to. This would be the same as well. These are lows inside fair value gaps. Typically, is what these are referred to. When a low is called like that, it's typically a low in a fair value gap. So we can see here, that would be, and those are typically good targets. You can see almost here how we came down and we took this the liquidity at this low. I keep like fake clicking on these. You can see how we took it and then we kind of fake reversed back up and then continued lower to take this swing low, just barely. So we just barely swept that and then continued lower. Now, so what have we done here? I'm going to say we did fair value gaps. So you know what a bullish and a bearish fair value gap is. Now, bearish fair value gap right here. It's a bearish fair value gap, just a random one. I'm not saying anything good about this, but... And now, these fair value gaps, you have to realize that the algorithm is always referring to these in the past. Now, is there a range on it? Probably. But could it refer to a fair value gap on this? We're on the 1-minute chart here. 30 days back, 60 days back, possibly. So that's why, like, you're never gonna have the full picture, but you have to be able to build as much detail as you can create to see, is how I would describe it. But okay. So we talked about order blocks. We talked about fair value gaps. Breaker blocks. Breaker blocks are, it's gonna be easier like this. This is a breaker block. So when we have a move up, and then we have a swing down, and then a swing up past this high, this will become a breaker block. And you'll see on my charts, I'll label breaker blocks in red. So what we can use this for is that when we have a fair value gap right here, say like this, have a fair value gap right here, and they line up, you can use this as a confluence almost to take a trade on the entry to that with your stop below that breaker, looking for, you know, higher highs than we made on this swing up. So you would look for, essentially, it would look something like this. That's what you're looking for. And you're waiting for this, you're waiting for the trade above, and you're waiting for the return for your entry. You're not chasing there. And that's where you can get some good RRs on that. So now we can, right here, that is the ICT unicorn model. It's called the unicorn because you get the breaker combo with the fair value gap. That's referred to as a breaker, a unicorn model. Sorry, I'm a bit brain fogged out. Brain fog maxing, you could call it. So now if we look back at these two trades from Monday that we could have taken, we'll look at the buy one first. Using just that alone, this is a breaker because we came up, we opened, we swung high, we swung low, we swung high above it. If this is a breaker and you pull it out right here, what can we see here then on where our entry would be? We have a breaker with this fair value gap. I'm going to say this for now, but this fair value gap. And now this is also something I'm playing with, I'd say, more relatively recently. Excuse me. But when we have a high like this, or a previous day high, or a previous day low, the most important thing with ICT trading, I'd say, is because you can see how many fair value gaps we have, order blocks, breaker blocks, all these things you can make, right? You have to be able to, narrative is the most important part. You have to know what side of the market that we are on. One of those things recently that I've been looking at that has helped a bit with that is that if we were, now this is going to be actually time cycle related, so keep this in mind for when we're going to go over time cycles. But when we take this London high, and we can see that this London high is right here. Now, we know based on the fact that when we have a swing high and then a swing low, and since we have this London high that we just took here, we know that that is a breaker block. So this is a breaker block from this high, from 54.75 to 460.75. Now we can see that maybe we mohawked, is what ICT calls it, but maybe we went over that a little bit for, what was it? Let me just do this, make it easy for myself. Yeah, so we can see that blue line is the low of that breaker in London. You can see we go over that barely, but what are we coming into? We're coming into this fair value gap right here. And you can see we come into this, we enter it, and then, I mean, a little bit choppy, but again, this is a Monday with no news, so you have to expect that, you have to anticipate that. And then we come up, we delay around this high a little bit, we come back, you can look how the bodies, where the bodies are. The bodies didn't enter that, go past the low of that London breaker, just a wick. Tap into here, the bodies held respecting this upper, see? Almost to the tick, I think. I think that might be the exact same price as that high. But you can see here how the bodies held this order block. And I mean, there's also a fair value gap right there. You can see that. Very little one. But you can see how they almost hold that. And then large candle, hesitation candle. This is to try to get some sellers in. Because you have to think ICT is all about, yes, narrative, as we talked about kind of here. So the quick way, by the way, for this is when you're looking at like a London high, you can almost just, and this is what you might see me do, I won't draw this bottom line, and I'm honestly going to delete it because it's going to make the chart too messy. I'll just take like the high and extend it, and you can just look at the high as kind of like a dig into that high and just assume that the breaker stops somewhere here, but we're not expecting it to hold the breaker perfectly all the time. Now, I say that, but when it does, and it will, there's times where it will. There's times where this wick won't happen and it'll just hold it perfectly. That just provides you even more confidence that we're in a buying program, essentially. That's how I will call it. We're in a buyer's program that we are, let me not turn this off, that we're going to continue higher. That's how you build the confidence in that trade. Now, so that would be, we did breakers and order blocks. Now, let me get first fair value gaps out of the way. So we have to go the whole way back to Monday. I said Wednesday. We have to go the whole way back to Monday because this fair value gap, now we're going to get an indicator out of the way too. I have an indicator just to help me draw these. So we're going to delete this box. And we can see here when we turn this indicator on, this is a very important PD array. This is almost the one PD array that you can just rely on the most. It's the most referenced one. The first fair value gap after market open. So we can see market open right here, 9:30. Now, the 9:30 candle doesn't count towards the fair value gap because it has to be regular trading hours. Now, okay, regular trading hours messed it up. So let me go back to Monday. That's not Monday. This is Monday. Can't go into regular trading hours. Good to know. Regular trading hours would have just deleted all this price action before 9:30. But 9:30. This pink box, and you will see me draw my first opening. I call it, it's the opening imbalance because it's the first fair value gap, will be drawn in pink. And you can see it, we can see it highlighted here. Now, this is just highlighted and drawn throughout the day. And now, look, you can just see based on this. I hate when I just grab random things. We can see that we have one trade framed here. Now, we took our trade up here based on this breaker, this order block. And essentially, not really on the previous day high. But, so I will say, using the narrative thing about taking the London down here. And why do we not have... we have to go back in time to get the correct drawings for our kill zones. One trade, two trades. I was saying, right, here we went above and we came back and we didn't come back and close below. Now there's two versions of, there's technically four versions, four different things we could be looking for here. Now this is actually kind of be the 2022 model as well at the same time. Now this will be the 2022 model as well as time cycles is what we're going to go over here. Doesn't matter that the pink boxes, it's fine. So this is going to be, we're going to go over time cycles here. Now we can see here that makes the chart a little messy, you could call it. But when we highlight, let me drag the fucking box, man. When we highlight all these boxes, what are these doing? Time cycles. Every 30 minutes, there is a new time cycle. Also, every 90 minutes is a time cycle. So now the algorithm will refer to both of those. So what happened in the last 30 minutes, what happened in the last 90 minutes. So you can understand that. And now, when we're trying to build our narrative, there's four different things that can happen. So these boxes are going to be the current time cycle. So we say we open up, we're going to use this line as, this line is the 50% level of these boxes. We're going to use this line as a point of interest from the last time cycle. So say we open up, this is our current time cycle. We open up, we come above the high of the last time cycle. So a box like this right here, we open and we come above this high of the last 30 minutes, right? Now we could do what we did here and we could come back to this high and then continue higher. It's a continuation. Or we open, we come above the high and we sweep it as liquidity, and then we come back and maybe, we don't always, maybe we come back this way to get it as support to continue lower. And then of course you can frame both of these the opposite way. So say we open, we take out the low of the last one, we come back, we continue lower, or the same as here. We open, we take out the low, we come back up, we retrace to that low, and then continue higher. Those are the four frameworks essentially that you can be looking for to then enter a trade after that framework has been completed. So we can see here that we have the London high, and we have all of these highs of the time cycles during London, and we can see that they overlap with our first fair value gap, which is very, very, very high confluence. Let me say that straight off the start. If you see that is a quite big confluent. That would cause a lot of confidence, in my opinion. That's like a A++ setup pretty much, especially if you incorporated time into it, which you can't really incorporate here, but we will discuss as we see it more later in the week. But so yeah, we're looking at, I brought that up because those four, you got to keep those in your head. That's what we're looking for. Now, when we come back over this London high, this is a continuation buy model. We come above the high, back lower, back higher. Now, here you would say, okay, but we swept it, and now we're coming back to the high here. Would you not expect it to reject off this and go lower? Well, you're not taking a trade there, though. So, yeah, maybe in your head here you're thinking this could be a sell model. You don't know. You wait until, okay, now we closed a high, big, huge candle, and we come back, and what did we leave here? We left these two fair value gaps. They'll give you the story. They'll show you the story. You're not trying to prove the story in your own head before it even develops itself, essentially. So that is the market. This MMXM is market maker sell model, market maker buy model. Those are the market maker buy and sell models and the variations of them. So now we can delete this. First fair value gaps. We talked about the first fair value gap here. Here is where we develop it even further. We're going to go into the 15-minute chart. Just for we're going to go back to the 1-minute chart. So now we need to draw this fair value gap. Why? It's already drawn. The first fair value gap of the day. Also, the first fair value gap of the week. It's this is the Monday. That's why we came back to the Monday, just for this. So we're going to draw that fair value gap. And my weekly ones, I like to make orange, just because they'll stand out. Orange, and the line needs to be orange too. Wrong one. First FVG of week. I'm going to make that orange too. That's red, orange. So now we go to the 15-minute chart because we are going to draw this out until Friday afternoon, market close. And we will refer back to this in the coming days. So we come back here. And you can also you also should be looking at the first fair value gap of the month. So you want to go back to October 1st, and you want to find that first fair value gap after 9:30 open and draw it out over the whole month. Now, we have moved higher quite a bit in the last October 1st is the whole way down here, and the fair value gap's like here somewhere. Now, this was a return like right above it, I think. It was close. I don't think it was precisely to it, but we don't refer to it at all during this week, to my knowledge. So I'm not going to be drawing it just for brevity's sake here. But so yeah, that would be first fair value gaps. First fair value gaps, done. Time cycles also has been explained now. That's these big boxes are 90 minutes, the small boxes are 30 minutes. We're looking at the highs and lows of these time cycles to essentially not prove, because prove is the wrong word, to allow us to create a framework for what we expect to see in the market and where we can then take a trade from. That's what we're using time cycles for. Previous day high and low liquidity. You also want to look at the last 3 days, not just the previous day. I will say that. That's one quite limiting factor of that indicator. That wouldn't be a problem if you were drawing them yourself. Like when we're today on Monday, you want to have this high plotted, this low plotted. You want this low, you want this high. You don't need this high, but you would want this low plotted as well. Just these last 3 days before the current day are all quite helpful. You also would want to look at any period arrays on the daily chart. Now here, I don't think we have any. Just changing from settlement to, I'm not sure if I just fucked up. I think I fucked up the day again. All Gucci. Back to Monday we go. Back on Monday. Okay. So I can go to the daily chart. I just can't change it from settlement to, that's fine. Now we're going to talk about daily range here. Daily range, you can see here we have some big candles, we have some small candles. When we have a inside candle or multiple inside candles in a row, you can begin to anticipate a higher probability that we'll have a large range day. Or after an incredibly large range day, you can expect the opposite, that we'll have an inside candle. So what can we see here? We can see, it's funny, this goes to Friday, but we'll look at the weekly daily range, I guess, today. So we can see that we had a relatively small candle compared to other candles here, Monday and Tuesday, and not a big Friday, which then led us to have a very large Wednesday and an inside candle. We didn't take the high or low the previous day on Thursday, which then led to a high candle on Friday, which we ended up taking all-time highs by market close. So with that being said, that would be the daily range. You want to look at the daily range to anticipate what you could think. So when we're on Tuesday night or Wednesday morning and we don't see this Wednesday candle, all we see is we've had a lot of little days. We can imagine, okay, Wednesday might have the opportunity to be a larger range day, which just means that you could hold your trades longer. You could hold your trades longer, or you could there could be a larger opportunity for bigger trades, essentially. But yeah, we're just gonna, I think that's all I wanted to talk about daily range wise. Now let me get time out of the way quick. Time, I'm only gonna bring up a couple times, but time, I just want you to even look yourself as we go through this. You can see at the bottom, it's highlighting the time. Look at what times certain things are happening. And that's the biggest thing I can say. Now, I'm going to highlight some key times, I guess. The 10 minutes before and after each end of hour. So what does that mean? Now, I say the 10 minutes, but you can even extend that to the 15 minutes. So that would mean 9:45 to 10:15. Now you can see, if you just purely observe though these 10 minutes, we focus on those 10 minutes. If we go back here, it's 5:30. We're not looking at that. Now here's a key thing. It's not every day at 7 a.m., 8 a.m., 9 a.m., 10 a.m. No, that's not what I'm saying. And that's not how it should work, because it would be too obvious then. It's some days at exactly this time we will reverse, or we will enter a fair value gap and then reverse. And it's just something that you should be aware of. So we can see, didn't really happen all day, but then what happened at 3 o'clock? We reversed here at 2:40, but time is what matters. We didn't sell up, we didn't buy and go higher here. Why? Because of time. We came back at 3, exactly 3:05. 308, 309, we continue higher and we go up, and then we go up into close. And what do we come back into? We came back into this fair value gap from 9:35 that we referred to 6 hours later, 5.5, whatever. That's the level of precision that you should be seeking, essentially. I'm not saying this is a good trade, but I'm just saying time is very important. Time can be the difference in a profitable trade and a losing trade, even though it could be the same exact setup, because it'll work at a certain time. That's the key part. And you can see that sometimes even during these times, now the ICT 2022 model is based on accumulation, manipulation, and distribution. So you accumulate liquidity, you manipulate to take the liquidity, and then you distribute in the opposite direction. So we can see here, during London, we accumulated these relatively equal highs. If you're a retail trader, if you're like a standard trader, you're drawing a box around this, you're saying this is resistance. When we come up here and we reject here, think about how many people are taking a sell right here. Market open, we open up, we hit this resistance and start going lower. Think about how many sellers are here, and where's their stop loss going to then be? Their stop loss is going to be right here. So here we accumulate, we manipulate lower, we take out these lows, these lows, these lows. Why are we manipulating lower? Because the real move is the distribution then higher. But we have to get the buyers out of the market before we can move higher. So we come down, we take out these lows pre-London. We take out the low from the New York PM before London. We have these London lows from last week. We don't take out the Asia lows. But we took out all this extra liquidity resting here. We take that out, we open, we even come fake swing down here. And then you can see it's painting the picture though for the informed people. Okay, we're coming down to this fair value gap and we're not coming down harsh, closing below it, closing below these lows, using them to continue farther. That's not what we're seeing. But if you're misinformed, you don't see that this is a fair value gap and this is just going to be a reversal, essentially, reversal signal. So we come up and then we take yesterday's high, we take these highs. Because why do we take these significant levels, yesterday's high? Especially when we have London right here, which we looks like we sweep and then go lower. But these are almost equal highs too. It's the same thing. This is retail resistance. All this right here, retail resistance. We come up and we take it deep knife wound. People think this is just going to be a shallow, and then we come to the order block and we continue higher because then all their stop losses are out. Imagine everyone that, oh, they got stopped out because this was their stop. Oh, but now we're going lower now. Re-enter. Stop loss right here. We took it again. And now we can get the move lower because we took out everyone who was selling. And everyone who was buying got, everyone who's buying, where's their stop loss? Their stop loss is this low, this low, this low. What did we do? We took this low, we took this low, we took this low. Did we come the whole way down here? I mean, technically, not yet. We still have to come down here. But we engineered these lows to then hit at a later date. And we're going to refer back to them. You keep them in the locker. You save it. And eventually we're going to come back and hit that. Now, I'm not going to keep these on because I didn't actually look at them this week. I have these on my other charts. These are new week opening gaps and new day opening gaps. Now, I add those to the chart. You can see it becomes very cluttered, first off, to say the least. I'm going to hide drawings just to help a bit. But you can see how we refer to these, though. You can see that when we come up here and that like pre-market swing over the highs and then the what was this? Well, there was something here, I think. Oh, no. So we didn't have this before. This was just looked like a push up and then a push back down lower. We didn't actually see that we pushed up here into this new week opening gap, I believe. Or maybe it's a new day opening gap. I don't know. It's one of the two. So now what is a new week and a new day opening gap? A new week and new day opening gap is when you open from yesterday. The market closes at 5 p.m., opens at 6 p.m. The difference in price is the opening gap. So it's just the difference in that 4:59 candle close and the 6 candle open is that. And it's a week opening gap when it's a Friday to a Sunday. It's a daily when it's like a Monday to a Tuesday. So we can see though, and ICT says to have the last 5 on your chart. So for new day opening gaps to be the last 7 technically, because it also draws the new week opening gaps. And then the new week opening gaps says the last 5. And you can see how this is what ICT calls true resistance. The market acts in these zones, how people trade resistance. You can see we come up and we sell off of it. We come up, we sell off. We come up, we sell off. We come back into this first opening gap. We come up. Where do we come up to? Look at precisely the new week opening gap. We come lower. We come back into it. We come lower. We hesitate a little bit, then we trade above it. Maybe we come back, trade back down into this and continue higher, continuation. You can see that you can use all these things. Like, look how small this gap is and what we're doing here. We're reacting to it. We're barely sweeping, reacting to it, all the way back up here to this gap into this fair value gap right here. And then we come lower. Here we sweep the constant encroachment of that wick, which we still have on our drawings are hidden. We still have on our text that we will mention before we continue to the price action. So you can see though, those, I wanted to point those out just because I do use those normally. I haven't been using those these week because it's just too messy on my charts to be able to have that. And I leave this open because 9:30 open price and midnight open are 2 important things you want to look at. So true day open is plotted right here. We can see, look at that precision right there. That come up, what do we come back down to? We didn't come back down into this fair value gap, we came below it. We came barely above the true day open, midnight open, and then we continued higher. And you can see when we look at our thing, I'm not going to be able to move my cursor because I don't want to draw a line. But if you look to the right, I'll move it here. Right here, we're bouncing off that midnight open perfectly to the downside. And then even almost right here to the downside. Here slightly to the upside, and then come under, back up to the downside. Here, up. Use it for support to continue higher and to close. So we want to keep that level in the back of our mind, essentially. And you keep it, the same in the lockers. We keep those equal lows below. You want to keep those just in your mind, thinking about them. Okay, they're there. I don't need to actively think, okay, what am I going to do? But, and then we can also see here, very, very key level, the 9:30 open will be referred back to by the algorithm. Look, right here, 9:30 open. What did we do? We swept it technically, but we know we were coming to this fair value gap. We were coming to the London highs, etc. Not the London highs. We were coming to this fair value gap though. Up here, we were coming to the London highs and the breaker block. This fair value gap, pre-market, continue higher. But 9:30 right here, swept, almost came to, and bounced on. We can just see. It's something that's worth looking at for sure, because it will be referred to quite often. All right, we got our drawings back. So now that is indicators and new day, new opening gap done. We talked about previous day, previous week, liquidity, the way it can be swept, the way you can have a model based on those sweeps. We come above the previous day high, we continue higher off of a return to it, and you're looking for maybe a fair value gap as well on that return to it. And we talked about time as well. The key times I would say that I've seen just in my personal study, 9 a.m. is a pretty clear time, 10 a.m., 11, 12. You can see 1, 2, and as we saw here, 3 p.m. tend to play out. That we're talking about the time exactly or within a minute or two, but also more importantly, the 10 before and after, 10 minutes before and after. So, that right here, this 10:50 technically, we can see we come up here to 11:10 when we made this low window. That's what we're looking at time wise. Now CE, so the consequent encroachment, as ICT calls it, we're going to get rid of this text actually, is very important for narrative from what I found. What's the consequent encroachment? The consequent encroachment is the 50% or the mean threshold of the PD array. So we have the first fair value gap. The consequent encroachment is that middle line, the 50%. Now, when we come here and we come up, we come above the 50%, we sweep above the whole thing a little bit, which is not a sign that we're not in a sell program, but it's not a sign that we're in a amazing, easy sell program. Now, here, when we come, we don't even have enough to tap the 50% of this. We come barely into it, and then we sell off of it. That is a very high confidence that we're in a buy program. That's what that tells you. Now, when you're in this candle and it's coming down and it's not going to tap it, you don't know that. But when we come down and we form this wick and then we continue upwards, then you know, okay, I have a very high confidence that we are in a buy program and that we are going to continue a lot higher to, at minimum, I would say this high is where you're going to continue higher to when you create something like that. And it's the same thing with a breaker, is you have the 50% level. Once you close below it, if you were going to use this as a sell breaker setup, you would ideally not see it come above the mean threshold or the consequent encroachment or the 50% level of that breaker. So yeah, I think we are ready to continue, essentially, price action wise. We can see here, we're just going to be kind of observing. I'm going to go to a hourly chart just because I don't even know if I looked at the charts I don't even know if I looked at the charts on Tuesday. So I'm going to draw a line Wednesday, 8 a.m. We'll take a look at Tuesday, though, and just see if, we can observe anything. Maybe you can observe anything before we get into 9 a.m. before we look at Wednesday. Let's go back. So we have to remember Tuesday is also a 9:30s down here. Tuesday is this was a non-news day, so we did not have a high confidence that I say non-news day because the news days are the days where you typically have easier setups, not necessarily, but more easier price action in that it moves more with more volatility. But we can see Tuesday that we get a nice, I don't know, nice is the word, but that's the thing. That's the difference here. We get a setup. It's maybe a B plus setup. It's not an A plus setup, but we can see here that we came traded into this opening gap after that we formed at 9:38. We came traded into it. We came up. Looks like we were going to reject off this. This is, keep in mind, the orange is the gap from Monday. But we came down and we stopped at the breaker here from the pre-market, the previous time cycle. Now, we did go below it a little bit here, but we have another breaker, / technically this is an order block. Now, when we're looking at consequent encroachment, specifically when we're looking at large wicks, when you have a long wick, you want to draw your consequent encroachment on that wick. So now this is just a random one, but I mean, it is perfect though. This is a long wick. You draw the consequent encroachment, and what do we do on this next candle? We came down to the 50% level of that. This provides the same narrative for you about if we got below it, you would be less confident that we would continue higher. If we came down to 3/5 to the 50% level, if we came down to like right here, you would have more confidence that we were going to continue higher. And I mean, you can see here again, the precision level that is exactly 50% is always going to be wild to me. I mean, you can look at something like this. We don't even need to, this is just, again, a random wick, 11:17 a.m. And you can see how we act around the consequent encroachment here. We barely come up above. We're still not trading over the wick, but we're trading deeply into the consequent. I laugh a little bit because look at this. We came in once, we came in twice. You might think, okay, we're not selling off hard though, so maybe it's going to be nothing, right? But wait till the time. It's all about time. 11:50. Finally, we come back in 11:55, 11:56, 10 minutes before 12. We came in, we come back down to that Monday fair value gap by 12:10. You get the delivery to that gap below that low. and you don't go below this low until later. And look at this. This is from the morning between 10 a.m. We come down into that Monday gap and perfectly reject off of it. Now 10:48, it's not in that 10-minute window, but it's in that 15-minute window. So I will say you'll have this at 10:48. Less often than you'll have it between 10:50 or closer to, say, 11 in this case. But and again, 11:03 though, we come up and we reject lower. Like, it's wild when you actually see it, and you can, not can break it down in this way, but when you can observe it in when you can observe it in this way. We can see this is a unicorn setup right here. So we have the high from the AM session right here, right? We have a fair value gap right here, and what do? We come back down into it, and we came up, and we took these highs. We didn't come up crazy because this is right before market close, which isn't really when you want to be taking a trade, I'll say that. But yeah, you can see like right here almost. And I will say this too, this is pretty key. Inversion fair value gaps, inversion breaker blocks. They're a newer concept that ICT has released publicly, but when we're using this wick to sell, right? If it's right here and we're coming into it, we're using it to sell. But when we trade above this wick, you don't just discard it. It flips now to support price higher instead of support price lower. So what does it do? We come down to the 50%. The bodies respect it, though. That's key. The bodies are respecting it. The wick digs down. As ICT says, the wick does the damage, but the bodies show you the story. So the bodies show you what's going to happen, and then we continue higher. Previous day high, exactly reverse, and you'll see this pattern a lot. We come to a level, we reverse, trap people in short, come take them out again. And these are just it's kind of seek and destroy type conditions, which is just when the market takes the liquidity on one side like 100 times. Like, it would be this, but much more jagged. Like, it's like it'll look like something like this, like deep retracements and then deep liquidity runs, and you just like never know when it's going to make that final move. But saying that, sometimes it would be the inverse of this essentially. If this high took this high, and this high took this high, and this high took this high, and this, but it did the opposite. It was kind of taking the lows here. You can see though that when you incorporate time, you can still find high quality setups in these conditions because it'll occur at a specific time. So with that being said, let's clear this drawing so we don't get distracted on Wednesday. Now, Wednesday, this is pre-market. Yes, pre-market. Pre-market, we've came down, we've tapped in here twice. This day was specifically why I wanted to do this, because there was the most crazy, air quotes, price action. I can play it, I think. Play it at like 3 per second. And I'll pause if I pick up anything that I remember and wanted to note. I don't even need to point it out. You can see how here pre-market we're coming into this. So we barely come above the consequent encroachment, which is, yeah, we don't like that, but we have a bearish fair value gap right here that I would say we didn't come up to the consequent encroachment of that. Well, we can verify it. Just eyeballing it, looks like we didn't. Looks like we didn't go above it. Sorry, we came pretty much exactly to it though, which is not what you'll see it a lot, but it's not what you would want to see for a perfect A+ setup. You would want to see this pretty much. So yeah, you could have literally, this could be your model essentially. Say you took your trade on the entry to this on literally just that low and just like that high. It's a 2.5 hour trade, and you would have made your money in 3 minutes, 2 minutes, maybe 2 minutes, 20 seconds, maybe, with a 6-point stop loss. That could be your model right there. That's 15 points. You could make millions on that model. That simple. We gotta Little sweep though, this liquidity here. All right. See what we're cooking here. So we open 9:30. We make this massive wick to the upside, super large wick to the upside. Going to, yep. Okay. You see this and you think, what's going on, man? How am I going to trade this? What are these conditions? Terrible market, etc. Now, this is some newer ICT stuff. Let's just say that. But we're using consequent encroachments, right? You can also look at the consequent encroachment between two liquidities. Now, these lows, there's liquidity at those lows. This long wick, there's liquidity at the end of that. When we look at the middle of that, the consequent encroachment, where did this candle just come to? The consequent encroachment of the difference between those two lows. Now I want to plot this for the same sake, 1.50, and we're going to leave both of those. And again, you could even go as far as plotting this, right? And you can see we didn't even come down and touch the 0.5 of that. I will say though, look at the time. What time did we come down? 9:51. We came down and we hit this. Interesting. We come up 9:58. 9:59. 10. 10:01. And you can see we came up here. We didn't tap this, but we came up, consequent encroachment of the gap from Monday. Now, how would you ever take this trade? We just did that 2 other times pretty much. And look what happened. Okay, fair. But what time? What time did we do that at? We didn't do it past 9:50. 9:50 we came here. Tells you the narrative we're going to go higher. Okay, from here we're going to go higher. Sure, I can understand that. Fair. Where do we go higher to though? Here. We stop here. We turn around. And then look at the sell-off. And we have the previous day low down here. I'm not even trying to be, I don't know if we hit this or not here. Okay. Yeah. So that would be your target though, realistically. Here, your first partial is here. Your second full, like terminus is what ICT calls it. Your full target is right there. Then we can see what we do at this low. Look, we come below it, but then we come back and we kind of trade. Now we'll see if we'll trade back down to it essentially, or we're just going to continue higher. Just gonna mark this for sake. Look again, when we refer to a consequent encroachment and we close below it, we don't forget about it, but we can come and we can use it to then continue higher. Always referring to these continuously. That's the thing you got to think about. And again, if you want to talk about time cycles, I know there's some more time cycles more precisely in this day, but say here you were looking for continuation on the sell side. You would want a return to this low. You would want to push below and not go back above the low. We come back above the low so sloppily. Like if we were to here, just stop pretty much here and continue lower, and maybe we got a fair value gap like this, and then you got an entry to it like in the next candle. This candle came up, gave you an entry, then you could take a sell for the previous day lows. But in these conditions, you have to wait for time. I hit the wrong button. We're going back to Wednesday. Sure. Went back a little too far, I think, but all good. So we know we went lower here at the time, 9:50, and then we come back up. We make that fair value gap. We return to it twice. Time here not as important, because you can see a lot of the times we will go from, this is high resistance liquidity run, hard to trade in conditions. A lot of the times you'll go from this to the easy moves, and then it might be easier price action later on. And you wouldn't have to worry about the time as much in the easier price action, essentially, is what I'm trying to say. Do I even need to say it? There's a reason we plotted it 50%, and look at it. The high of that candle, top left, looking at it right now, 24.5775. 24.5775. It's the exact price that it referred to. Exactly. And where did the bodies respect? And where did this candle respect? The fair value gap from Monday. And we trade lower off of that. That's all I'm saying. All I'm saying. I'm not sure how much more I had on this day. I can't say I recall too many. I mean, like, yeah, there's more trades that could be taken, but again, like in this day, you would want this trade, and you would probably want this trade would be a decent trade. I wouldn't be against. Now you can see here we have the previous day highs the whole way up here. You're not targeting that previous day high because we went so low in the London and Asia and the afternoon yesterday that you're not going to be targeting that high. But you see this level, this would be your target, or above that level, you know? This would be your first partial for sure. These would be this would probably be a terminus. This would be your final target, because like if this is your trade, 9-point stop, and you're even just looking for an enter on that fair value gap, that's 80 points. You can see the risk to reward, it's 8. You don't need to even hold to that, but even if you do, you get it precisely to the tick. Like, it is some crazy stuff, to say the least. Crazy stuff. I mean, you can see here we're coming to this fair value gap at 1050, and then, I mean, again, I just want to point out the time, 11:05. We come back up and we refer to this fair value gap that we made at 10:52, last 10 minutes. Fair value gap, return to it before the 10, and then look how we dump just in those next 5 minutes, the whole way down here, 11:15. I'll stop this if I see anything that I want to point out, or if I remember. I mean, again, here we don't really get, not really. We get a sweep, a come above, and then we come back and we just kind of tap it, and then we come up to take this high out. And again, though, look, we're still trading inside this bearish fair value gap, so we're not. That's the thing. When you're in like markets with these huge fair value gaps, you have to always think about risk management, keeping your money safe, essentially. I will point out, though, this as a sell I wouldn't be against, because where are we coming to? We're coming to not the last time cycle, but the 30 minutes before, the low right here, which is a breaker. We have this fair value gap. We came up into both, a little bit above the consequent encroachment of that wick. We don't trade above the 0 of that wick, though. And then we continue lower off that, and you could even target this low, whatever, you know. I don't even know if I've looked at the do I need to say it? 11:59, and what did we do? We came up at 11:59 to the top of this and then reversed. I don't think it needs to be said, but let's see what we're doing to close here. I don't even know if I've looked at the afternoon session of Wednesday. I probably have. Can't say I recognize this price action. So you can see when we're in, I would call this open waters here. We don't have anything really here. This is a daily gap I had, I think, drawn out. You can say then come and you can look at these. And you can, when you draw those on the chart, you can see most of our gaps are up here. If I were to add more gaps, we would have some gaps down here that we could be referring to reverse at. But yeah. So I think we can probably continue to Thursday now. see if there's anything. Right here, if you want to frame a sell model, low, we continue up, we open, we trade low. Once we trade below that, look how we come back and we refer to that to then continue lower. Now, it's not you'll get this every single time it's going to go higher or lower, but this is something that is a signature in price that when you see it, you can predict that it's showing you its hand that it's going to go higher. It's the same thing here. This happened, and this could be, this again, as I said earlier, this could be your model. You wait for, this is a unicorn setup technically, and look to consequent encroachment, didn't touch the second time. Specifically, you wouldn't really want to take this trade because this is going into market close, which is always risky. But this one, yeah, I wouldn't say anything poorly about this one. The only thing poorly I'd say about this one is that you're shorting in discount. ICT teaches discount and premium as premium is up here, discounts down here, of the range essentially is what it's described as. So if you can imagine that this is the range for the day, when you are buying, you want to buy at a discount. When you're selling, you want to sell at a premium, because you can imagine when you sell at a premium, you can then buy down here and then you make your profit. When you buy at a discount, you can sell at a premium. It's pretty self-explanatory, but those are the terms. So that's the only thing with down here is bias wise, it's kind of like a obvious thing, but when we've already came down so much, it's more of a retail mindset, because when it shows you a signature like this, it's telling you, hey, I'm going to go lower. How much? Maybe you don't know. How much you need to do a little swing projection. You say, okay, from this high to this low, swing fib. Okay, maybe I'll put my target at, 2 or 2.5 or 3, or watch, if I do 4, it's probably going to be like quite not negative 3.5. We can look at 3.5 and almost 4. But so, I'm sure, I think if you put it to this low, you can see we basically swept that 4 level. So you can use the fibs for when you're in those open waters to determine your levels, because if something were to be algorithmic, then it would technically move also pretty much algorithmically. So like if this move is 100%, then it's going to probably move down 2 or 3 or 4x that move, essentially. That is how I would say the market does end up trading most of the time. So we'll go 4 hour, and we can just do 1, 2, 3. I might have went too much, but excuse me. I had allergies in my room with my windows closed. Love that. All right. So Thursday, we got we're at 4 a.m. This is London, but high of a time cycle. We trade above it, we come back. We continue not much higher, but that's, 10, 12 points. The minimum points ICT would take a trade for, as he said himself, was 10. You want to be in a trade where you can get at least 10 points out of it. And that would have been doable in that trade. So if you would have, taken it, managed it. No, I just did way too much, I think. No, I somehow didn't. Oh, I did hourly, not 4 hours. So yeah. But we can see here already, I want to point this out, how we come down. Now this is in this time cycle, not the next one, but we come down and then we come up and we just barely come up into these time cycle lows here before we then drop. And this was messy price action, I believe. ICT had like 2 losses Thursday because he was just trying to push it hard in bad conditions. But you can see, how we open, we take out London low. You can see there's still always going to be precision in the chop, which is what this is. And you can see we're chopping pretty much just around that opening gap. That's not really what you want to be trading. You can see we're still, okay, we came up to the low from this bearish breaker here, and we tapped it, but we technically also tapped it here, and I think we're going to tap it a third time if I'm not correct. And you can just see how it's still messy. Yeah, did we have a reversal pretty much at 11? Yeah, but we only came up to this gap, and we continue lower, and then 11:05 we came back up again, and then we have a reversal at 9:50 pretty much. Yeah, at 10 o'clock exactly. Yeah, so again, you can see that the time is still there in bad conditions. And look, this would probably I remember seeing this. This would be your trade of the day. The problem is it's a hard trade to take because it's not a model I've mentioned yet, and it's not a model I like taking. But you can see we sweep the AM liquidity and the Asia liquidity, which is pretty significant. Previous lows are the whole way down here, highs are the whole way up there. We're not going to take those, right? So we can't really consider that for a trade. Now, I want to just look at where the true day open is. Yeah, true day open right here because I haven't been looking at that. But I know for a fact, I think, where's the true day open? This is Wednesday, 1 a.m., way too far back. True day open. I think I might just be blind, or it's not marked maybe for yesterday. Oh, it's the whole way up here. So we didn't really refer to it Wednesday much. Maybe Friday. Maybe today was when we referred to it. I know there was a day where, I mean, even though this, you can just see kind of how we act around it. A little bounce here, a little bounce there, a little wick up into it. That type of, but this would be your trade. So the problem is, though, that, I mean, you can see time-wise, it's 11:50, which is what you're looking for, right? 11:50 move. You can see we get the 11:30, we get this nice move down. You would have to take the trade on. So this is how dodgy that one guy I sent you trades. I'm not this specifically. This he probably took this trade maybe. This is a sweep of the buy side liquidity. So everyone who's in a buy based off what their stop loss these lows gets stopped out. Asia low is taken out, and we make a fair value gap, but you expect this one to be inverted because of the nature of taking out these lows. So then when it gets inverted, you enter on the close after the invert. So you enter right there on this candle open, and your stop loss is below the gap on a candle not closing below the gap. And then again, your target would be like this liquidity. So that's a hard trade to take, though. I'm not saying that I would have taken that trade. What trade I could have taken would have been this one. I probably would have taken if I was on my charts yesterday. 12, key time for a reversal. 12 exactly, I think, was this high. 12 exactly. And then we get a perfect fair value gap. These are the fair value gaps you want to see with a nice return to it. I would also say stop losses. ICT himself said it's pretty much always fair to do the high/low of the candle that makes the fair value gap for a stop loss. Sometimes it needs to be bigger, as you get more precise, you can go smaller. But, and I mean, yeah, here you could just target this low. And it's a nice 1 to 5. Would have played out in, 12 to 12 minutes for 57 points. Which, I mean, you can see this is on 0.4 contracts on NQ. That's $600. So, I mean, here you then 12:12. We're past the time, but you get a nice sweep, push up, 12:30. The times are a bit different during lunch because lunch has its own specific macro times. That's what 11:50 to 12:10 is a macro, because it's called a macro, I believe, because ICT has said that that's when the algorithm does specific things. As you can see, we get these reversals at these specific times. So that's why it's called a macro. But yeah, I don't think there was much in the afternoon. From what I remember looking at when I looked last night, I believe it would have been. So we are coming into, market close. I mean, and then again, you can see you got another possible buy setup you could have later in the day. Look at the time, 2 p.m. on the dot. Exact. In here, and then trade off. I mean, that is a 3 p.m. reversal as well. So let's not forget about that. But yeah, it's a different level of precision and manipulation. We can say that. So one, two, three, four. That's too much, I think. Yeah. It was too much, but it's actually all good because we're gonna delete that first. I know I missed. There was another one of those. There was another scenario where there was like a long wick and then equal highs, and you could throw a fib between them, and it would and price trade it back into it. But I can't remember which one it was, and I'm not gonna go back to find it. So we'll have to live with that. Um, yeah, I remember I saw this morning because I was up for it. First, we have this low, right? Yesterday's low we took out pre-market. We came up, came back, tapped it, continued into again Monday's gap. Trade a little bit off under it. We finally come up above it, and then what do? We come back to this high, this breaker, bullish breaker, pre-market 830, reverse higher. Then what? The high of this right here, we came above it, market open, we came back to the high, and then traded off higher. Now, this is the first fair value gap that the thing, that the, what's it called? Indicator marks, because it doesn't have a filtering process for width of fair value gaps, but it is technically a first fair value gap, and we do technically come and like bounce somewhat on it. So I'm not terribly against it, but so I think I'm pretty confident I drew this out today, and I'm just looking at it now, and I can see why I would have drawn it out, because we have a bullish breaker here. Not even it is well, it's more of an order block because it's not a swing high, but it's a down close candle and an up close move. So and you can see how we're reacting at it. So you would almost have to say for a sell, I need to see us get under this, and then you could be worrying about a sell. So you can see now we're, I mean, again, there though, that's not even the reaction that you want to see. I mean, yeah. And again, you can see if we're looking at that the market maker buy model, that we need to get under this low and then use it for support to go higher. You can see we're just kind of chopping around this order block. We're not really being decisive. This isn't perfect conditions. This is what you want to. This is not what you would want to trade ideally. And if you're looking for a sell, you want us to get under this low or under this low, use it for support, or just get under it and go from there. You don't want to see us do this chop around. I mean, okay, now we see this. This is the cleanest. I don't like that it came to the consequent encroachment of this, but this is the cleanest under back in that we've got. Now, I didn't take this trade because I didn't trade this morning. But if you were to, I mean, here's the problem too. You pretty much have to mentally prepare yourself that any of these gaps along the way, it could theoretically turn around at. So in an ideal world, you take like MNQs, micro contracts, and you would take like 10 and you would close, 2, 2, 3, whatever, and you hold for the lower liquidity, because you never know how long it's going to go. I'm going to take this, but that's 9K. Yeah, right. Paper trading, obviously, because we're in back testing, and I don't remember, and I wouldn't really recommend that as a trade, because it's not an A+ setup when you have all this time. It's 11:30. I'd never trade after 11. Now, I don't know why it stopped, but I would say when you look at this, it's, I mean, obviously you want the setup here. I'm up 500 technically. You would have wanted to buy here probably, obviously not here or here, and you're just in a little drawdown here, but you're not really sweating. When you buy down here and you chase, you have to weather all that drawdown, and it's not a fun time. But now 1150, maybe you're a little bit more confident in it. We can see what happens here, and you can see, okay, we got to 1156, 12, and maybe we're going to turn around here, or maybe we're going to hit one of these and we're going to turn around lower. And also, I would say if you were in the trade from here, when you go here, you come back here and you take this. As soon as you take this low out, you move stops to break even, and you cover costs, commissions, like you move stops like there, and you would cover costs. I don't have much confidence in that trade playing out. Yeah. So, I mean, you can see though, this just really depends on your greed level essentially, because this trade is a break even all day. You take it here, when it comes here, I mean, you honestly, you take a contract or two off here, you lock profits in, and you close at break even when it comes back up to here, and you're calm. You're profitable on the day, and you're not sweating about that. I will say here, if you're trying to frame another sell, you can look at the high here, and you can see that we're coming up into the high, and then maybe we continue lower off that. And I say maybe we continue lower, and we do, because we don't always continue lower. You have to set up the framework for the trade to be able to play out. So again, time-wise, we came in here at 1254. So it's likely that we will continue lower. And even in here, what did we do? We came below this low. That's what you want to see. You want to see a push below this low. You can see here, this isn't really a push below the low, and we came back. It's not confident push below, back, and down. That's not what we want to see. We don't want to see this. This is increasing our lack of confidence in the trade to play out how we would want it to play out. Whereas this, we close below, and we open, we close, we don't close, we come back up, we tap it, and we look at the big candles sell down. And I mean, now I would assume, I don't remember actually, I don't even think I've seen any of this price action. We come down, we tap that opening gap, come down, tease that Monday fair value gap. 210, 150, not this one, but 140, 120 of that one, 250. And then we can see that's the end of the week there. So yeah, I mean, I hope there was some value in that. Don't take that trade as your model, but I pointed out what other trades obviously would be taken, could be taken. I mean, yeah, this could be your model though. And you can see this is the thing about trading, is I took a sell here and I bought here, and I technically, I think I would have, I lost 5K. Say it was one contract, right? You lost 500. You could have taken this trade right here with your stop real tight above that high, and you could have been looking for just these lows. That could have been your trade. You could have been in a trade after someone took this and gotten out before they got stopped out, and you could be profitable, extremely profitable, because the strike rate of this is going to be very high, 80% plus, but the RR is 2. So you don't even need an 80% win rate. You need a 33% win rate, I'm pretty confident, is the math that works out on that, to be break-even trader. So even at a 40% win rate, you're profitable. So, yeah, it's... I mean, again, right here, we got that unicorn set up, right? Point it out just for the sake. Below, back in, sell off. Back in, sell off, but I mean, we did come to the 9:30 open. I'll point that out. We came to open and we came to AM low right here. But then when we do it time-wise, 150, we come back in for the unicorn setup. We come take out this low. Bam, there's your model. You're taking a short. Even if you're not, you could take them. I mean, when you look at both of these, you could take it at the consequent encroachment, but ICT always says to take it on the entry. So you take it like there on the entry to the breaker. And you can see the stop has to be a little bigger on this one, 22, sorry. And you look for this low. This one's a 3-to-1. Would have gave it to you in 14 minutes. That's it. You can use a lot of things to frame your narrative, and when you build your narrative correctly, your strike rate, your win rate will be very high. And you'll see that you'll be on the right side of the market in your mind, but you will still make human errors. Like here, exactly, would be a human error. Buying down here instead of waiting, buying here, or not buying at all and just being okay with, I'm saying buying, but I mean selling. Not buying at all and being okay with missing the trade. Human error right there. So, oh yeah, well, that was all I got. And let's do a little reveal. Hour 20. Sheesh. I'm giving you an ICT video right here. GG's, man.